All right, awesome. Nick, why don't you just tell a little bit about yourself, and I'll share a little bit about me and City and State and the team here, and we can get to it.
Perfect. Well, really appreciate everybody joining today. My name is Nik Merrick, or Nick is just fine. I'm the Senior Director of Commercial Finance at Knapp Associates. Really excited to speak with you guys today, provide some educational pieces, and allow people to really navigate the commercial finance side in the environment in which we find ourselves today. And I've been in this space for the better part, say, at least 7 years. And have thoroughly enjoyed the process of delivering value, engaging in long-term friendships and relationships, and just really educating folks in that process so that they can make educated decisions in a market that's very hard to predict.
Awesome. Well, and I've known your principal over there for a really long time. We've got a lot of friends in common, and great group over there. City and State Real Estate has been around for almost 4 years now, but we've had a team helping with residential and commercial real estate in the Portland metro since 2006. And we're primarily referral based and really big on educating our clients, which is why we like to bring events like this to make sure our clients and friends and brokers have the most current knowledge to, again, make informed decisions. So with that, all right, I'm learning how to do this. I swear I've done these before. All right, Nick, go ahead.
Yeah, this is the preview. So today we're going to kind of have like a more macro conversation, addressing big picture items, introducing some minutia so that people are able to understand and maybe even pre-underwrite properties on their own. Certainly, when you find a property that meets your needs, or your perception is that it meets its needs, that's when you can engage either one of us to get some fine details, get granular about if viability is present or not. So in that process, we're going to start out with perspectives, right? And so there's really 3 parts to this. There's the buyer, the seller, and the lender. Obviously, when we have cash on cash purchases, the lender is not present, but then neither am I. Certainly, Nick can help you out exclusively with that. There is a fair amount of that. There's institutional investors who are participating in that in wholesale in our country, but that's not really where I come into play. I come into play when folks are seeking debt. And so when you're looking at properties, we'll go through all the different commercial real estate tranches. But when you're looking at properties, there's different practices that come into play in order for the process to be as smooth, to be as predictable, and to be as positive an outcome as possible. Clearly, whenever we engage in a large purchase, and we really focus in on purchases that are in the class of loan size in $2 million and above, we can certainly consult with folks below that $2 million loan threshold. But that's not really our sweet spot. We are in that $2 million above zone. And, typically we're looking at transactions 20, 30, $50 million and above. But we do service clients at a floor of $2 million typically. So in that lens, let's go ahead. We're going to go to commercial funding, series, class of bucket tranches, and then of course the current pricing and forecast of where we see pricing going. Really through the end of this year. Beyond that, I don't think there's any value in commenting, but let's go ahead to the next slide. Okay, so here we have perspectives, as I had began talking about. Really what we want folks to do is engage. When you sit down and you're starting to look at properties, we really want you to have a process by which you approach that activity. And so what we really encourage folks to do, both when they sit down with either Nick or myself, is to create a hierarchy of needs, to have a solid understanding and foundation for what it is you're seeking to accomplish, and to have the means by which to follow through on that goal. So that's where that metacognition comes into place. Sitting down, creating a hierarchy of needs, then constantly referencing that through the process, from the time you're looking at different properties, to the time you make an offer, through the time we're in formal underwriting, and then when we reach the end, That allows us to really look at, have we honored our goals? Have we met our goals? Have there been some items that have popped up that we did not perceive would be coming up? And have we navigated those in an ethical manner that allows everybody to finish the transaction with high fives and hugs instead of frowns and disgruntlement? And so we've been really great at making sure that those hugs and high fives are the outcome that we're seeking really every time. There is a piece of caution, right? So we talked about metacognition, now we go to caution. Caution is the notion that when I'm looking at properties, I'm, to the best of my ability, not allowing my emotions to dictate whether a property is a model match or not. A lot of times we can be fans of architectural styles. We can be fans of commercial real estate classes and just sticking to those classes. But as we've seen in this marketplace, certain classes of commercial real estate are non-performers. I'm looking at office for the most part. We can talk about that trend and where it's going during a consultation. But doesn't mean that offices are fully excluded. There's owner-occupied opportunities in the office space that can be fruitful. But from an investor perspective, maybe office is something where we should be very cautious about and really look at occupancy trends. Over the trailing data, certainly we've got great turbulent times to look back at in the past to see how an office class commercial real estate asset performed. But, you know, so some of them did really well, most of them did really poorly. Are there some conversion value add opportunities as a result of that? Certainly, let's consult, let's talk about it. And then finally, one of the things we have to really understand, especially as it relates to the negotiations that you will work with Nick in terms of creating that ideal purchase and sale agreement. And then when it's transferred over to me for formal underwriting, and certainly before that, the canvassing, the whole process where I'm going out there and I'm talking to between 10 and 20 different commercial lenders to find synergy, to find optimal value, and to find a model match for you and your lending partner, which is a relationship that will exist typically for a minimum of 5 years, but with yield curve constraints, it's looking more like 7 to 10 years. Patience is a virtue that will allow you to get through the process with your sanity intact. If you have no patience, that's something where we're going to turn to our yoga classes, our meditative breathing practices. We're going to really try to help you to just kind of understand that taking a deep breath, allowing events to manifest themselves, and then trusting your partners like Nick and myself to come in there and exercise our fiduciary responsibility to you to ensure that you are protected throughout the process. Finally, I would just add a note here, and that is that, again, certain times we get caught in our portfolio being of one commercial real estate class. And there's a book called Who Moved My Cheese, and it talks about how opportunities can move, and if we don't follow those opportunities, we miss out on tremendous investment opportunities. As an example, just because you see a property that seems to be an optimal price, that doesn't mean there's a lender for it per se. And we have seen that occur where there's been really corrosive externalities around certain commercial real estate classes, like hospitality is another really tough one. You may see an ideal price on a hospitality asset. Doesn't mean there's a lender there to help you with it. Of course, we have a wide variety at MK Plus Associates. We have over 110 different lending partners. And so there's very little we can't do. Just know that the more exotic you get, the more exotic your pricing will be as well, in terms of the cost of capital.
Yeah, the riskier it is, the more it costs. That's just kind of the way it goes. And the same holds true with cap rates. I think sometimes people can get seduced by very high cap rates, but that usually means there's repairs needed. It means there's vacancy problems, management problems. So those, really attractive prices or really high cap rates come with some work to do and with higher risk.
Absolutely. There is value add financing available for well-heeled investors. So for all those folks out there who have expressed extreme financial discipline, have a great pot of liquidity they can nest egg, they can turn to, you really can turn certain properties into incredible investment opportunities. Just say as a final note on that, we are seeing institutional money looking at office space and converting it into multifamily, high density multifamily. That's something we're going to see continue to evolve, but absolutely, we don't want to just offhand eliminate any commercial real estate class. We want to look into our own personal financial statements, our own capacity, our own resumes as investors to find synergy. All right, I think the next slide. All right, so here is the critical piece. Now, if we're not doing a cash on cash offer, again, I'm not there. I'm here for you when you need debt instruments. And so it's really important to understand that hierarchy of underwriting. Now, the first one is absolutely the top ingredient in terms of finding a suitable outcome. The other ones all play a part. In other words, they are integrated, but not necessarily in a hierarchical fashion, the way debt service coverage ratio is. Debt service coverage ratio is a means by which we can determine net income as a ratio. And to find that on a more global scale, there's granularity to this. But basically what we're going to do is we're going to look at the annualized regular and reoccurring income, and then we're going to divide that by the annualized regular and reoccurring expenses plus pro forma debt service. That allows us to understand if a property is viable from a commercial lending perspective. Typically speaking, in the multifamily space, we'll see that debt service coverage ratio for acquisitions be at a 1-to-0 debt service coverage ratio, which actually means a 20% net income, inclusive of debt service. For refis, that actually goes up to a 1-to-5 or a 25% net income. Now, when we go into other commercial real estate tranches, we see that though that debt service coverage ratio underwriting criteria will go up significantly. The factor there is because banks need to ensure that they are not absorbing toxicity on their balance sheets, that their portfolio of commercial real estate assets are performing and can sustain modulation or volatility in terms of performance. That is mission critical for lending partners as they look at things. Loan to value. Loan to value is secondary to debt service coverage ratio, but nonetheless, and depending upon the lender or loan instrument we utilize, has ceilings. We tend to, at Knapp Associates, operate in the high value space primarily. Having said that, we do have hard money or private money that we can offer to folks where it's applicable. But that loan to value has ceilings, most primarily limited to debt service coverage ratio. And if you're looking at properties on the whole, I want you to really think about a 65% loan to value. That's safe, that ensures viability. And it also allows expectations to be beaten rather than simply met, or worse than that, expectations to be not honored. When you're talking to a commercial finance broker and they're telling you they can get a 90% loan to value on a property, 99% of the time that person is not honoring their fiduciary responsibility to you, nor are they being transparent and honest. So set your expectations at a sort of the average. When it's beaten, all the better for you. And when it's not, your expectations are dashed. Then we get into loan size. Loan size pertains to different products in the market. If we want to really find value right now, and we'll get into this in a minute, but it's going to be an agency product, Freddie Fannie product. And Freddie Fannie product is really structured in large part about the size of the loan. So if we have a $2 million loan, we can expect underwriting criteria to be at a certain set. And really, that's a personal consultation. I do have another slide here that will be an easy reference tool to you, but it would take too much time for me to go to in granularity during this talk. But if we've got 2 million, 6 million, 9 million and above. And as it turns out, the larger the loan size, the more generous your lending partners are in terms of their loan to value, in terms of most especially their rate offering. That leads us to another important ingredient, which is geography. geography plays a huge part. Geography is related to risk. The higher the population density or tier, the better pricing you're going to receive. Why is that? Well, during times of economic recession, we know that the properties that lose their value first are those typically in tertiary markets. Now, during COVID, we did see movement to tertiary markets from densely packed urban centers, which is a deviation from historical norms. However, banks work off historical norms, and even though that did occur, banks still favor high density environments over low density tertiary environments. So it's important to understand that. There are exceptions to that rule when we talk about infrastructural projects, transportation, energy, distribution. Those are typically in more tertiary markets. And so there's all types of instruments that can be utilized to serve that need. But on the whole, for your everyday investor, geography, density of population means a lot. Finally, we get to quality of trailing data. Let's say that you're taking on a property, and that property, maybe there's a deceased previous owner. That property is has been inherited by heirs who have no experience in dealing with that property. And so they didn't keep any trailing data. Maybe that property has been owned, so there weren't annualized reporting obligations to a creditor, right? That makes things challenging. Again, remember, your lending partners want to see trailing data. They are in the business of risk aversion, not risk absorption. And so where we have a lack of trailing data, again, that's where Nick does a really great job of figuring out how can we create that data based on real information. And then, how can we make sure that we're presenting that to a lender so that it meets their needs and their underwriting criteria.
Yeah, that's kind of brings up a really important point. Is a lot of times clients will self-manage properties to save money, and that makes some sense. So for example, we own our office building in Portland. It's not that difficult to manage this building. It wouldn't make sense to pay someone else to manage. Our bills are on auto pay. We're here every day because we use the space. And so it's easy, but we also have to make sure we keep good records. We've got multiple tenants, the expenses, all of that. So you have history, but a lot of times when folks manage properties themselves, just like Nick said, if no one's asking for annual reports of your rent rolls and capital expenses and your income, a lot of people just don't bother to keep it. They maybe keep enough to do their taxes, but it's not going to be a very detailed list. And I want to mention something else too. When you talk about debt service coverage ratio, sometimes people call it a debt coverage ratio. We use both of them kind of interchangeably. In really simple terms, what that means is the lender wants to know that you're making more money net income wise than it's costing you to pay the expenses in the mortgage. So for example, a 1.25 DCR means if you're going to borrow at a level where your cost is $4,000 a month, they want to make sure you're making at least $5,000 a month of net income, so that if you have a furnace you need to replace, or you have a flood, or you have a tenant not honor their lease, so that you're still have enough income from other tenants or reserves to make sure that you're not taking every dollar you make and then immediately giving it to the lender. So like Nick said, that doesn't put the lender in a very secure position. And honestly too, for you as an investor, we would love to see you make as much money in cash flow as possible, no matter what the future potential upside is on a property.
Perfectly said. Totally agree. Now let's go on to lenders and food groups. All right, so we have a large swath of lending instruments and opportunities to provide you with credit. And so you can kind of go through here, the ones that stand out to me, and we can kind of get into that in a couple of slides, is understanding who does what well, right? Private money and hard money, these are bridge funding opportunities. We're turning to them because we have a property that does not underwrite to traditional conventional financing, that we do see light at the end of the tunnel. And as my partner and principal, Michael Knapp, says, that light at the tunnel, end of the tunnel needs not to be a train. coming at you, right? So light at the end of the tunnel. And so we have a path by which we can utilize this expensive hard money to provide value add capital improvements and get occupancy maximized, income maximized to that which is legal. And then we can convert that note into a conventional instrument. Then we have local credit unions as opposed to federal credit unions. With lending purposes, for lending purposes, the primary differentiating factor about these two is that one has prepayment penalties, the other does not. By charter, all federal credit unions have no prepayment penalties. All local credit unions have prepayment penalties. They can be negotiated. That is one of the services that I will provide to all clients, is negotiating and minimizing prepayment penalties. There's a lot of negotiations that go on with our local credit unions, our federal credit unions, our regional banks, and that is differentiated between agency. When it comes to agency financing, there's no negotiating your prepayment penalties. These are typically yield maintenance driven instruments, meaning when you utilize that high value instrument, and in the market that we see ourselves in the pricing market and the inflationary forces that we're experiencing right now, by far our agency pricing is the value add opportunity in terms of cash flow. It just is. The interest rates are so much lower that if you can, and we're talking about multifamily now, if you can utilize them, you owe it to yourself to do it. The one thing to bear in mind with agency is that you're in it for the ride. If you sell before maturity, you're going to get hit with yield maintenance. And that means that you're going to pay up all the interest that you would have had you held the note to maturity.
Nick, can you speak on the Fannie and Freddie? To one of the things that a lot of people are looking for now is, because interest rates have gone up, is the current loan assumable to a new buyer? How does Fannie and Freddie typically deal with that? Is that something that's built into their process, or is that something you have to negotiate, or is that not able to be negotiated?
Negotiated. Yep. Depending upon who you're working with, that is negotiated. That is the funny thing about Freddie Fannie financing, is the conduit by which you receive that financing does have quite a bit of sway with Freddie Fannie. They have their own Freddie Fannie representative that works primarily for the bank, but also plays a dual role with Freddie and Fannie. And so that is something that we can negotiate. The prepayment penalties is something that we just can't.
Okay. Yeah.
Yep.
One thing too, I just want to touch on a couple of points. You said the word negotiate, and if anyone, I remember my first experience personally doing a commercial loan, and I worked with a local credit union in Boise. But at the time I was talking to 5 other banks and credit unions, and I bought an office building right when COVID started. It was kind of a contrarian purchase, and some of the lenders were not interested at all. Some of them were definitely interested. I went with the credit union because I was able to not have a prepay, and that was important to me. And I was also able to put a interest cap on the second 5-year term. So I knew that my maximum blended rate I knew what it would be. So I got a higher rate at the time. It seems great now, but at the time it was a little bit higher, but those were the things that were important to me. And I think it's really important, that's why Nick and I have, why he has a job as a mortgage broker, is because it's not like a typical residential loan where you lock in your rate and it is what it is. You can't change any of the terms. I was really surprised when I finally picked a lender, and I went back and I just, as a courtesy, let the other folks know that I was talking to, that I had chosen someone else. And one of the groups that said they did not want to do an office deal said, well, no, we can do it now. And what kind of rate do you want in terms? And I said, well, you told me you didn't want to even do an office, and now you're saying you'll do it and you'll match the rate and terms and everything. And so commercial financing is very much negotiated. And that's something to keep in mind, because if you haven't done that yet, or you haven't done it in a long time, there are so many different options, and every lender on this list has different rules and different kind of hot button things that they will negotiate and certain things they will not negotiate. So thanks for, let me kind of add some color to that.
100%. And, when we talk about what is negotiable, especially in that Freddie Fannie lens, and, we can kind of talk about commercial mortgage-backed securities market, but, if we stick with agency for right now, that's pricing. We have an index, we have a margin. Index is non-negotiable, period. That's their cost of funds. That's what it is. But that margin, that's that they'll fight for it. And really, that's where we pride ourselves too, is, we represent clients who are worth fighting for, business that's worth having, right? And so our lending partners know that. And so that when we're approaching them, we are expecting them to negotiate. It's funny, when I first got in the space, it would be a lot of times I would speak to a VP at a lending institution, and that VP would really want to make sure I wasn't talking to any other lenders. I think every single VP I work with now knows 100% I'm talking with other lenders, but I'm transparent about that. And it is also the case that in this market, there needs to be backup options, meaning a transaction, given this market, given chief credit officers' temperaments, there can be times when a chief credit officer, for whatever means, for whatever reason, has a bit of a freak out and says, nah, not doing it. And the rational discussion isn't going to happen. They're just not doing it. So if, as a broker, I haven't lined up option B and C to back that up, I've got a client who's sitting there in an incredibly vulnerable position with earnest money on the line. I can't have that. The lenders understand that this market is highly turbulent with lots of volatility. We have to practice discipline, focus, and protection when engaging with our clients and representing them in the credit marketplace. Okay, so we talked about agency HUD. I've got a slide that the HUD cheat sheet that comes after this one. I'm really not going to talk about it. I do get hit up quite a bit in terms of folks wanting to understand both the 223 and 221 HUD programs. One's for development, one's for acquisitions. And so, however, given where interest rates are right now, HUD does not make a lot of sense. It's an extremely long queue. There's huge volatility and rate risk. Rate risk meaning that we are in an inflationary market. And if you've got to wait 9 months, 6 months minimum, to understand what your rate is going to be, you could be in a totally different world, and all of a sudden that property doesn't underwrite anymore. So I really kind of let's not talk about HUD, even though it's a really cool program, 40-year amortization for development projects, 35 years for acquisitions, refis. There's value there. Certainly when we were in the cheap credit environment that we've enjoyed over the last 8 years, we're not there anymore. So is that a model match? Usually it's not. So anyway, if folks want to consult on that and really get granular about it, happy to do so. It's just not an instrument that we're seeing a lot of activity the way that we were in the last several years when we were doing a lot of them. Okay, CMBS, commercial mortgage-backed securities. This operates in a similar fashion, I would say, to agency, in that there is value add opportunities there because the rate environment can be very attractive. Commercial mortgage-backed securities market incorporates not just multifamily, the way Freddie and Fannie does, but all commercial assets. And so because of that, if they are, again, loan size of $2 billion and above, and they are performing assets, we can get some really healthy, happy competition amongst creditors in that space to deliver value on your behalf. They are very complex, as is the following tranche, which is swaps, the swap market. The swap market is not something I can address on this call because we're going to talk for an hour about that by itself. But know that these are instruments that we can use. And there can be benefit in high volatility credit markets where swap instruments can be to your benefit. That is a super customized conversation. Again, beyond just stating that it's an available product. I don't see value in going into that right now. And then same thing really with insurance money. Insurance money is you can get nice long amortizations, but your resets are really frequent. So you've got 5 times 25, for example, meaning your loan is going to be reset every 5 years with a 25-year maturity. And so we can talk about the forecast where we see cost of capital going. I'm not really comfortable in that 5-year zone. I really like longer instruments where we can get past this period. I think we're in for some turbulent, high, real value add opportunities coming up. But I really like the longer money for the time being.
All right.
So, yeah.
And typically insurance, so when you're talking about insurance money, we don't mean like your car or homeowner's insurance. But it's really life insurance companies that are doing very large loans typically. What would be kind of the smallest loan you would use insurance money for, or you've seen that used for?
$2 million.
Oh, they'll really go down that low?
Yeah, they will go down that low. Yep.
Okay.
Yep.
Yeah, because my experiences with those is it's usually in the institutional level size, 20 million and over, those are where people go to get the financing. So.
Oh, no, that's actually true. A lot of times you'll see a bunch of notes packaged together to create those tranches that are absorbed into the life insurance market. But we have in the past gone as low as $2 million with that. But this, again, a lot of insurance companies, life insurance lenders are really not turning a lot of product right now. That's just a fact. It is true that it is largely tapped by the institutional market for large-scale projects. We have a project in San Jose that we're looking at right now, which would probably be an ideal candidate for institutional money. It's over a $200 million loan, and for multifamily housing and commercial on the bottom, mixed use. But outside of that, yeah, for your common investor, insurance money is not going to be the play.
Okay, great.
Really good point. So we'll skip that one. That's just for people to reference. We'll be providing this PowerPoint to folks after the fact, so that's there.
Yeah, and if you for some reason don't get it, just reach out to me here at City and State, and we'll have copies this we can send out to you if you're on Facebook Live. But if you're on the call, we should have your email, and we can send it out to you this afternoon.
Yep. All right, so a lot of times people aren't seeing the true diversity that exists. And actually, I'm looking at this list. So this list is all about the different commercial real estate classes. I really don't see senior care here. Senior care is a space in which we actually do a fair amount of products and certainly have in the past. But, yeah, you can go through this list if folks are thinking maybe they want to look outside the box, try to find value, want to look at different opportunities. You can reference this list, talk to Nick, see where he's seeing opportunities in these different tranches, and then make some steering decisions. I do want to say, however, that some of these classes, let's talk about like golf courses, for example. There's golf courses for sale, but they're really hard to finance. That is what we call, and those in equestrian centers are under the passion project investor side of the space, right? I mean, they're tough. Hospitality and resort, it really depends, right? Like on the size, is it flagged? Is it not flagged? How's the trailing data doing? There's a lot of short-term rental space that kind of fall under that, but there's very few lending opportunities for the short-term rental space. Again, because, conventional lenders are going to go off of long-term traditional data, performance history, and that short-term rental space has been one that's just emerged over the last 5 years exponentially. The areas that we see a lot of appetite, multifamily, distribution hubs, manufacturing, owner-occupied, certainly. The flex office warehouse space, industrial, are all great. Retail's rough.
Yeah, I would, it depends on the type of retail too. I mean, there's nuances inside of all of these. Your traditional, like go to the big mall and buy clothes, retail is really struggling. But what we call service retail, so getting a haircut, a tattoo, getting your nails done, those types of things where you have to physically be there to do it. Like you can't, get your haircut online yet. And you can't have Amazon, come to your door and do your nails for you. So the places like you have to physically go to seem to be doing pretty well. And we're seeing strength there, but it's really difficult for kind of the commodities retail and kind of the merchandise retail, where there is a lot of competition online, and and sometimes it's quicker to have something delivered to your house and to drive off and go get it yourself. You don't want to necessarily focus too much on that.
Absolutely. Great points. And I see our time is moving a little faster than I thought it would. So let's go ahead to current pricing, where we see it currently. Now, what is today? Wednesday? And I made this pricing on Friday.
Yeah, it's already changed.
It's changed a lot. Yeah, it's changed a lot. So we're seeing a lot of inflationary forces across our indexes. And so again, I think I've alluded to this a couple of times, but agency for multifamily, that's where we're seeing great value. Our local banks, our credit unions, they have different elements they can offer, but they too are facing a lot of times increased scrutiny from regulators who are auditing their balance sheets, their portfolios. They are risk adverse, 100% they're risk adverse. And I would also say that in terms of like timing and patience, metacognition, all those things that we talked about at the beginning of the presentation, they come to play. We are in dynamic times. Dynamic times mean defensive strategies, and defensive strategies means that decisions are not made quickly. Everybody has to take lots of deep breaths, know that you're in good hands. You will be honored, you will be taken care of, but there's always a million negotiations that we do in the process. It's funny, Nick, I was talking with a client a couple of years ago, and they had noticed that, the interactions between myself and that individual had been minimal over a period about, we were checking in like once a week. So this client was like, well, what are you doing? And I said, well, let me show you what I'm doing. And it turned out that time I'd written over 400 emails on their behalf, and, whoever knows how many calls, I could count that number of emails. That is how much work that we are sheltering you from. That is how many negotiations that we're sheltering you from. Anybody who's gone through and done commercial finance on their own understands that it's a monumental task that's far more complicated, arduous, and quite frankly, frustrating, oftentimes, than they would have imagined it could be. And so just know that, all will be well, the value will be achieved, but it requires lots of deep breaths and faith that you're in good hands. On this sample I hesitate to want to read through it, but I would really honor you guys and encourage you guys to please go through and do so, and understand, because there's lots of great information in there. I just think it's something that you guys could read through. It's fairly well thought out and disaggregates a lot of information from, again, agency pricing down to regional banks, down to federal credit unions and local credit unions in terms of what you can anticipate for pricing. Just know that, we'll get that in the next slide, that inflation is hitting us. It is. Cost of capital is going up. All right, so let's see here, our forecast. So while the Fed does not dictate pricing across all indexes, we have a general trend here that can be observed. That general trend can have some correlations to performance in the stock market, certainly has correlation to CPI, inflation, job performance, job market. And so there's a lot of different pieces that go into what creates our indexes. In this case, we're talking about the Fed's posturing and what we are predicting. So I know, for example, on September 20th and 22nd, I'm anticipating at this point, my best guess is 100 bips. We're at 5.5%. I'm anticipating we're going to be at 6.5%. And so let's see here. And then November, 50 to 75, so some decreased risk. Ideally, we're seeing some pullback. I am of the mindset, to be very transparent, that there is one of two scenarios transpiring right now. The first scenario is that the Fed is creating a cushion by which to pull back pricing in the event that we have a market collapse, so as to assist in recovering and adding faith in our markets. And so that is why we're seeing such dramatic pricing increases to the Fed index, or the inverse, in which we are on sort of a one-way path for the next, let's call it 5-year minimum, of increased costs of capital. You can see that I have, for 2023, who knows? I really no idea. But I can definitely state that increased cost of capital is the trend, and we will see where we end up as things transpire. Again, ideally, what we're doing right now is creating and so we'll be able to recover from there. And are you still there?
Yeah, we're back. I think we just switched out.
We had a little break there. So no, I think what I'm saying is that either we have a pro forma approach of the Fed creating a cushion, or we have just an increased trajectory toward increased costs of capital over the next year plus and maybe several years. Bear in mind that over the 40-year average, the prime index has been about 5.85%. We have been so used to cheap capital that anything above the fours feels like we're being it feels usurious to many people. But regardless, the environment that we're in is the environment that we're in.
All right. Yeah, I think you mentioned something too that's important to note is that there's two components to every total interest rate percentage that the consumer sees, right, or the investor sees. And you showed that in the previous slide, that there are certain benchmarks and then there's the margin. And I've been hearing that as the benchmarks are going up, the margins are compressing because the lenders are still looking to do business. Are you seeing people pull back from the market in doing less loans, or are you seeing them compress their margins, which is the profit the lender makes over kind of the base rate?
So we're seeing both, and it's really depending upon who's running the show at each institution. Those institutions that are here to deploy to meet their goals, they are reducing, they're getting competitive and reducing their margins to win business. There are several, and kind of really depending upon what the project is, and that's where that in-depth consultation takes place. So we are painting in broad strokes right now. I would say that margins are getting reduced on the whole, or that lenders are simply not lending. But it's more of the first than the latter.
All right. So if you have questions, please put them in chat. Jordan Fessler is going to be joining us now to talk about the real estate market and what we're seeing here in the Portland Metro. We are very active. We did about 150 million in sales in the last 2 years, and this year is very strong as well. There's a lot of money out there. We're seeing a lot of exchange money crossing over state borders and moving around from one asset type to the other. Jordan, are you there? Ready to talk?
Yeah, I'm here.
Excellent.
Okay.
Well, let's start with multifamily. I know we have a lot of that going on right now, and Jordan's been involved in, over 100 million in transactions in multifamily just in the last couple of years. So let's talk about kind of what we're seeing in that market.
Sure. We're specifically talking about the Portland metro market, since this is where we do a lot of our business. The housing market is definitely seeing a shortage. Development has slowed down quite a bit, and the apartment buildings that have been developed over the past few years are filling up pretty rapidly. You can see on the slide, the absorption of multifamily has been very, very strong, including rent growth of 7% across the Portland market. Newer construction multifamily has seen rent increases by 13 to 15% on turnovers. So apartment owners are seeing their rents go up dramatically over the past couple years. Vacancy is very low. just below 5% in the Portland market. And that's where a lot of lenders are underwriting vacancies. When they do their operating expenses, they will include vacancy on a property. Cap rates on acquisitions are at 4.3%. I'll be curious as where that stands in Q1 of 2023 on closings from this year from right now till the end of this year. We're still seeing properties that are trading in the high 4 cap range, low 5s. We have some properties that we have listed that we came out of the market at a 5% cap rate, and we have had a lot of interest. And we're going to see how we're going to do on the lending side and getting good debt on the property. So we're trying to act quick, quite honestly.
Yeah, we are. We're trying to get stuff together in the next 2 weeks, really, to try to get, a lending partner engaged, get rate locked in so that we know what, so the investor knows what their margin is going to be and that they have enough income for the debt coverage ratio and for any bumps in the road in the future, and a reasonable profit margin for the risk they're taking.
Yeah. Industrial is another incredibly strong market. The industrial market in the Portland and the metro area has been very, very strong. There is definitely not enough space, and they're not building enough product to fill all the demand. The vacancy has been at an all-time low at 3.7%, and it was even lower at the beginning of this year. Cap rates, while it says 6% there on cap rates for acquisitions, my knowledge on larger industrial sites, they even saw cap rates trading in the mid 3 cap range, which is remarkable.
And we're talking about very big properties with national like Amazon and things like that. That's not your neighborhood metal clad building. That's Class A new,
right,
20-year leases kind of deal.
Yeah. Again, rent growth has been phenomenal for property owners. With industrial, we likely see that continue to grow, and the absorption on properties has been very good. So if you want to acquire an industrial property, or you're probably going to get that leased up relatively quickly at a very good rate. On the flip side, office has been struggling. That whole office dynamic is changing quite a bit. I know we're on Zoom now. A lot of companies have gone partially remote or fully remote, and we're working with some property owners that are trying to figure out what they're going to do with their office and how they're going to have their staff, if they're going to come in, if they're going to come in partially. So that market is pretty volatile, and we're likely going to see it change quite a bit for the next couple of years while business owners decide what they're going to do. If they're going to downsize, upsize, sell their properties, it's across the board. So I know that there's some groups that we're working with that we've been trying to help navigate that process for them and see what that's going to look like.
There's also a lot of people that signed leases right before COVID hit, or, they are in the middle of a 5 or 10-year lease term. And there are a lot of those owners that I'm talking to who are the tenants, they're renting space. They're definitely looking at downsizing or not renewing space. I still think there's going to be a story for office. I don't think it'll go away completely. We've been on about a 1% growth per year trend of work from home. And before COVID, we were already at about a 9 to 10% of the workforce was working from home. Obviously, it went to like almost 100 for office people, and it's come back down quite a bit. But I do think that's accelerated it. And not only have employees experienced working remote and being able to travel more or spend time with their families, there's a lot of businesses that have been able to hire top tier talent that wouldn't move to their market, but if they can work remote, are willing to help a company grow in a market where they wouldn't necessarily want to live, and vice versa. And so that's created new opportunities and definitely problems for local Class A downtown office.
Absolutely. You can see on this graph that the rent growth has been relatively flat. Sale prices for these properties is relatively low as well, $228 per square foot. That's a metric we like to use when we're looking at a property if it's a good investment. At $228 per square foot, that would be a below replacement cost. So if you're going to get land and develop a property today, it's going to cost you way more than it would be if you bought this product at, say, $200 or $230 per square foot. So long term, it could still be a very strong investment if you're considering using that metric.
Yeah.
So retail has been bouncing back. It had its struggles, but I know Nick covered it a few slides ago. But retail is definitely bouncing back. Service retail specifically, like the hair salons, barbershops, Amazon proof is what I like to call it. So yeah, we're definitely seeing the lease rates go up. We're seeing vacancies come down by quite a bit. And we're seeing pretty strong absorption numbers on the retail side. So a couple of years ago, people were really, really scared of retail, but we still think it's a pretty strong market as long as you have good tenants and strong leases in place, and triple net leases where, you know, the tenants are covering most of the operating expenses for the property.
Awesome. Jordan, thank you so much for this review. This is all of our information. We wanted to honor our time today. I'm going to pull up the chat real quick. I think we did have one question Mark Logan had asked. I think this is to you, Nick. How would you expect these two scenarios to affect pricing in commercial real estate? We touched on that a little bit with margins. Kind of, I think he's referencing, you know, are they creating a buffer? Is the Fed creating a buffer by raising rates more? And I can't remember what the second scenario you thought was, but are we going to maybe to see prolonged interest rate growth? Do you have any thoughts on that?
Yeah, absolutely. I mean, I think you summarized that perfectly, right? And I think that, you know, traditionally speaking, there's intertwinement between cost of capital, leverage debt, and the ability to sell an asset at you know, at a higher price. Now, one of the things that we do need to bear in mind is that there is a lot of foreign direct investment in our commercial real estate markets that is keeping pricing up. Why? Because other countries, their currencies are being devalued expeditiously through inflationary forces. And so if they have the ability to place capital in this country as a safe haven, harden their liquid assets into, you know, solid assets, real estate, then they're going to do that, even if it means with all cash, even if it means that that property will not perform as profitably as the placement of their cash would suggest. What does that mean? That means that we could continue to see price increases while we see cost of capital go up. Now, this is a complex conversation, and the statement that I just made does not bear across all markets, geographies, or property types. It is usually in our larger commercial assets that we're seeing that type of activity. Again, I think consulting with Jordan, consulting with Nick or myself about how these are going to affect a particular investment that you choose to make is the most prudent decision you can do.
Excellent. We have another question for Sandy about, the question is, what is absorption? That's actually a really good question. So that is used, absorption means how much space is being occupied. So on the slide we had before, we talked about apartments, and that's done in units. So it was, I think it was a little over 5,000 units. Basically 5,000 units were moved into. So that's a positive absorption. Negative absorption would be, let's say we had a big employer leave the market, and a lot of people that were working there had to move out of town. You could have negative absorption where there's more vacancy or more units or more square feet being put on the market. So when we talk about multifamily, we say how many units were absorbed. And when we talk about industrial, office, and retail, we talk about square feet of space. There's another slide or another metric we didn't put in there because development has slowed down, but that's also deliveries. So delivery is how much space was added to the total available square footage of, say, industrial. And then absorption is how much of the total space was either filled or made vacant by people leaving. So Well, thank you guys so much for coming today. We're really excited that we had a really great turnout. Jordan mentioned that we're all here on Zoom, and we used to do these in person, and I'd get to buy everyone lunch and get to hang out for a while, which is one of my favorite things to do. But it's great that we're all able to make time without having to drive across town or rush to and from appointments to be able to make this happen and really benefit from this education. So, Nick, I want to thank you so much for going into this. It's one of those things that such a huge topic when especially if your experience is in small multifamily or residential, to understand just the complexities. And we really just touched the tip of the iceberg today, but it's a really good overview. I certainly learned a couple new things, and I appreciate your time today.
Oh, honored to participate. Had a blast, and really appreciate you and your team. Look forward to doing these events in the future.
Excellent. Thanks. Everyone have a great day and a great week.
Thank you, everybody.